Okay, so this question 92, will help feed the rest of your questions. And I'm going to be theoretical about this and tell you what's really happening, right? So you understand how it works, and then you can then quickly go through this again. So remember that, first of all, we should never really touch fixed overheads. Just that someone has felt that, especially a management accountant has felt that it is okay to even assume that fixed overheads could be variable. And that's not the case. The standard case should be you have a budget, you have a budget of what you think your fixed overheads are. Imagine that's rent. They actually happen, and there's a difference. And that really is it. That's what should be the case. That's what should be the case. And if you left things alone, and this is typically what you'd see marginal costing accountants do, who recognize fixed overheads as period costs. This would simply be called a fixed overhead expenditure variance, and that would be it. But you have these people who don't think so, and so we end up also having to incorporate this idea of the fixed overhead expenditure variance. So let's do that in this question, and you can apply that theory to the next two, to 93 and 94. 93 and 94. So let's begin. So we have here that budgeted overheads are 20,000, okay, and the budgeted output is 10,000 units. So the management accountant says to themselves, okay, listen, I believe therefore, or I argue that we will be spending, or I wish to assign £2 to every unit. So every unit that goes into the financial statement, to the management accounting statements, he will assign or she will assign £2, hoping that it would naturally arrive according to budget at 10,000 units, and they would nicely have in the accounts 20,000. So they're hoping to arrive at this sort of debit fixed overheads, 20,000, and credit the accrual. That's what you're hoping to arrive at. But lo and behold, actual output is 12,000 units. So from your financial accounting point of view, what you end up happening to do is you actually end up going debit fixed overheads, because you're putting in 2 times every unit, you've put in 12,000 units. So your accounts are actually showing debit overheads 24,000, credit the accruals 24,000. And we've already done this. There's a number of ways of doing this. I'm just doing this practically now as the first way. Now, the first, and I remember I use, sometimes I use a scale, and I'll start off with the budget and write the budget itself of 20,000. So the first thing you know to do, if you remember, because this is what's happening in your accounts right now, the first thing you know to do is to sort of say, well, listen, we have currently over-absorbed. So I'm going to put through another journal to bring this down. So you're going to put through a journal and say, listen, this is wrong. So I'm going to credit or debit the accrual with 4,000, and credit the income statement, or where the actual expenses. Remember, this is an expense, this fixed overhead. Credit the expense with 4,000, right? I'm just going to bring it down to, sorry. Let's do this right. Um, how can I do this? Let me do this in this order, so that if this, imagine this question hadn't been there. I just want to do this first. So you would say, okay, listen, um, let's bring this back down to the budget, what we actually thought it was going to be. And this action of, you've put 24 into the accounts, you're now bringing it down to 20, if you like, in a way, is what am I saying in a way? This is what's referred to as your volume variance. It's sort of saying, listen, we've put 24, it should be 20, but because we're bringing it down, we're easing the accounts of 4,000. In effect, we're reducing expenses by 4,000. So it is a favorable variance. The 4,000 is a favorable variance. Because, like I said, if we had left things alone, we would just simply be comparing the budget with what actually happens. So the question here is, well, what did actually happen? Well, what actually happened was that um, the charge was 5,000. Sorry, 25,000. So now you can compare. Well, the budget was 20, the rent is 25, and so you have a £5,000 adverse variance. Now, what would have happened is that the person who drew this up would have just seen 24, seen 25, and said, oh, there's a £1,000 overall adverse variance. But that 1,000 adverse is broken up, if you like, into the 4,000 favorable and the 5,000 adverse. But the way to think about this, I'm going to use this as a teaching question, is that listen, I need to first of all bring my sort out my accounts first of all and bring everything back to the original budget of 20,000. And that's your volume overhead. Then you now compare that budget with what actually happened, and that becomes your expenditure variance, right? Because that's what you'd have done if you hadn't touched any of this, but you touched it, and so you now have this inflation in your accounts. You need to suck all that inflation out, bringing it back down to the budget, and that's your volume variance, and then compare that with your what actually happened, and that's what we call the fixed overhead expenditure variance. Cool. Great. I hope that helps. I hope that helps. Yes. Okay, so really, like I said, this way first, or whatever it is, compare your volume variance, your whatever is in the accounts, and what's in the accounts is based on your fixed overhead absorption rate times the number of actual units, right? Because you're putting in a certain amount for every unit, and so you get there, and then you compare. You basically have to get it back to budget first, and then compare that budget with the actual event itself. Okay.